Welcome to the deep dive. Today we're jumping into Casey's General Stores specifically, their first quarter results for fiscal 26 and what they see coming down the road. Our goal, just to boil it down for you, give you the key takeaways on what's going on and why it actually matters. Let's get into it. All right, so Casey's just put out these Q1 numbers ended July 31st, 2025, and honestly, they really catch your eye. I mean, look at the consistency here. Diluted EPS, that's earnings per share, it surged to $5.77. That's up, 19.5% from last year. Net income, same story, $215.4 million, also up 19.5%. And their EBITDA, earnings before interest, taxes, depreciation, amortization, that key cash flow metric, $414.3 million, climbed almost 20%, 19.8% actually from a year ago. Just really solid growth across the board.
It really is. And what's striking, like you said, is that consistency, almost 20% growth on all those core metrics. It tells you something's working right. So the big question is, what's really fueling this? Is it just good market conditions, or is it something more specific to how Casey's is operating?
Yeah, that's exactly it. Because numbers like these, they don't just happen. Casey's CEO, Darren Revelez, he pointed to a few things. Said they had strong sales growth both inside and outside the store. I mentioned positive traffic from their summer merchandising plan and just outstanding execution by the team. Gave credit to the fuel team too. And importantly, the fact they're running 221 more stores now compared to last year. So it sounds like a mix, right? Organic strength plus that expansion piece.
Absolutely. And, the CEO's comments really highlight that it's not just a rising tide. There's a real strategic effort here. The fact that profitability metrics are up alongside revenue suggests those new stores are, profitable additions, not just adding scale. And that outstanding execution piece, that's key. That's turning promotions into actual foot traffic and, running the register. A very strong start to their fiscal year.
Okay, beyond those headline numbers, what really got my attention looking to the details was the performance inside the stores. It feels like a huge strategic focus for them. What exactly are they doing there that's working so well?
Yeah, that inside the store piece is where you really see their differentiation strategy paying off. So inside same-store sales were up a solid 4.3% year over year. But what I think is even more telling is the two-year stack that's looking at growth over the last 2 years combined. It's up a remarkable 6.7%. So this isn't just a one-off good quarter. It's sustained momentum. And then you look at the profit. Total inside gross profit jumped 14.8% to over $705 million. And critically, the inside margin stayed really healthy at 41.9%, actually ticked up 20 basis points from last year.
Wow, 20 basis points up on margin while growing sales that much. That definitely suggests they're selling smarter, not just harder. What's the secret sauce there? Is it the product mix?
That's exactly it. That shift towards items with better margins, it's clearly a core part of the plan. Prepared food and dispensed beverages were particularly strong. Same-store sales in that category, up 5.6%. And that includes, their famous whole pizzas, bakery stuff, non-alcoholic drinks, things that carry a really high margin, around 58%. Even the grocery and general merchandise side saw good growth, up 3.8% same-store, with a decent margin itself at almost 36%. So what this tells you is Casey's has really moved beyond just being a, typical C-store. They're a food destination now. And that favorable mix towards food is definitely boosting that overall inside margin. It's smart category management in action.
Right, being the fifth largest pizza chain in the U.S., that really changes the game for a convenience store, doesn't it? It feels like they're capturing that whole grab-a-meal market.
Absolutely. It's a really sophisticated strategy. They're not just competing with other gas stations. They're effectively competing with quick service restaurants and doing it very well, especially where they operate.
Okay, but you can't ignore the fuel side for a C-store. How are they managing that? Because the fuel market can be, pretty wild. Margins there are usually much thinner than inside, right?
That's a great point. Fuel is often the volatile piece, yet Casey's showed real strength there too. Same-store fuel gallons actually increased 1.7% compared to last year. That's pretty notable given the market. And the fuel margins stayed, robust is the word they used, 41.0 cents per gallon. So total fuel gross profit was up 18.8% to nearly $374 million. That points to some really disciplined pricing and sourcing.
And I saw something about renewable fuel credits adding value too. What's that about?
Yeah, that's an interesting detail. Often gets missed. They sold $6.7 million worth of renewable identification numbers, RENs, during the quarter. That was up almost $2 million from the year before. These credits are basically generated from their fuel operations, and selling them flows right to the bottom line, helping support that healthy fuel margin the CEO talked about. It's just another kind of layer of operational efficiency, finding value beyond just the pump price. Adds a bit of cushion to that fuel business.
Okay, so really strong Q1. What are they telling us about the rest of fiscal 26? What's the outlook look like?
Well, their guidance for the full fiscal year suggests they expect continued strong performance, maybe just normalizing a bit after this really exceptional first quarter. They're projecting full-year EBITDA growth between 10% and 12%, which notably lines up perfectly with their longer-term goal of double-digit EBITDA increases. For inside the store, they're looking at same-store sales growth of 2% to 5% and expect the inside margin to hold right around that 41% mark. On the fuel side, they see same-store gallons being relatively flat, somewhere between down 1% and up 1%.
Those still sound like pretty solid targets, especially building on Q1. What about costs? And are they still planning to add more stores?
Operationally, yeah, they expect total operating expenses to rise about 8 to 10% for the year. But it's worth mentioning, in Q1, their same-store expenses only went up 3.0%. They actually managed to reduce same-store labor hours by 1%, which helped keep that number down. Shows pretty tight cost control. And yes, expansion is definitely still a major focus. They plan to open at least 80 new stores this fiscal year. That'll be a mix of M&A, buying existing stores, and building new ones. The bigger picture, their 3-year plan, aims for adding around 500 stores total.
So yeah, not just relying on existing stores, actively growing the footprint. That must take some serious cash. Is their financial footing strong enough for that?
Oh, absolutely. They're earmarking about $600 million for capital expenditures, property, and equipment this fiscal year. That signals real confidence. And their balance sheet looks really solid to support it. They mentioned having about $1.4 billion in available liquidity. That's made up of around $458 million in cash, plus roughly $900 million they can borrow on existing credit lines. Plus, they still have authorization to buy back another $264 million of their own stock. So yeah, they have the financial muscle to chase that growth aggressively while staying flexible.
It's all pretty impressive. But how do they keep doing this year after year, putting up these kinds of numbers in what seems like a tough, fragmented industry? What are the core advantages that let them sustain this?
Right, that gets to the heart of it. It really comes down to a few key differentiators that make up what you could call their growth algorithm.
Okay, let's unpack those.
Yeah.
Because it feels like that's the key to understanding their execution. First up, you mentioned their unique footprint.
Exactly. Around 2/3 of their stores are in smaller towns, 20,000 people or fewer. And that's not by accident. It's very strategic. In those rural markets, they often face less direct competition from the big national chains. Gives them a much stronger position. It's generally cheaper to build, buy, and run stores there too. But here's the real kicker. They talk about having substantial white space to grow. Get this, about 75% of towns in their distribution area, between 500 and 20,000 people, don't have a CASY's yet. That's a huge runway for growth where they can basically come in and dominate.
Huh. So they're carving out these competitive moats in markets others might just ignore. It's almost like the modern version of the old town general store, right? Becoming the essential stop in places where, a big Walmart isn't feasible.
That's a great way to put it. They become part of the community fabric, not just a place to get gas, which ties right into their second big advantage, that prepared food business we talked about.
Yeah, the fifth largest pizza chain thing still kind of blows my mind for a convenience store.
It's absolutely central to their model. That high-margin food drives incredible inside margins, best in class, really. And they're smart about it, too. They push their own private label stuff, over 300 items, competing directly with national brands on quality, price, and, importantly for them, profit per item. Gives them control over cost, quality, builds loyalty.
Okay, and technology. Loyalty programs are everywhere now. How does Casey's use theirs?
They call it a best-in-class rewards platform, and it's got over 9 million active members. That's a lot of customer data. It lets them drive bigger purchases, get people coming back more often, and use personalized marketing to nudge behavior. It's a really powerful tool for keeping customers sticky.
And the last piece you mentioned was vertical integration.
Yeah.
Owning their own supply chain. How does that fit in?
Yeah, this is huge, especially for serving all those rural spots efficiently. They own 3 distribution centers and their own fleet of fuel tankers that deliver about 60% of their gas. This gives them, as they put it, positive control over the value chain. Means reliable service, consistent products on shelves, better cost control, especially getting goods out to those potentially harder to reach stores. For you, thinking about it as an investor, it means potentially more predictable margins, less vulnerability to supply chain hiccups, a real edge.
It really sounds like they've built this robust, almost self-sufficient system. They know their strengths and are just leaning hard into them, especially as the C-store space consolidates.
Precisely. And these advantages aren't just, abstract concepts. They're directly plugged into their current 3-year strategy. That strategy has 3 legs: accelerate the food business, grow the store count, and enhance operational efficiency. And the Q1 results, the guidance we talked about, that's the proof it's working. It shows how they can realistically target that consistent 8-10% EBITDA growth. You see the efficiency focus in things like simplifying store tasks, streamlining kitchens, adding self-checkout, even looking at AI. It's all connected.
So wrapping up, you've got a really clear picture now of Casey's strong quarter and their path forward. From leveraging that high-margin food business and smart fuel management to their methodical expansion into underserved areas, they're clearly executing on a unique playbook.
Yeah, and if you connect this to the bigger picture, maybe for your own thinking, it really shows how deeply understanding your specific customer and market and then executing relentlessly on a tailored strategy, even in what looks like a simple industry, can drive really consistent compounding growth and financial strength. It's a case study in strategic focus.
So maybe here's a final thought for you to chew on. In a world where so many companies chase the biggest, most crowded markets, how much real lasting value is there in finding and truly dominating a white space that others tend to overlook, building that loyalty, that moat, brick by brick?
Something to consider perhaps next time you're grabbing a slice or filling up.
Thanks for joining us for this deep dive.